All right, welcome everyone to today's live video. We're going to be talking trading psychology. We're going to start off with just going over the sort of topic of treating trading as a business and what that all entails, and then we'll go through certain issues or problems that you're currently experiencing or have experienced, and we can see if we can go through them. So it's very important to distinguish between trading when you start out or trading as a hobby, as a side event, and trading when you decide to go full-time sort of trading professional. Now, trading like a business should be for all forms of trading, but I'm just sort of wanted to start there where a lot of people sort of go on a good run early on and they think that they're ready to give up their day job and to become a professional trader. And the first thing I will say is that it brings with it lots of pressures and a totally different environment. And what I mean by that is if you're trading part time and you're learning the ropes, which is 100% the way to go, it doesn't matter if you have a break even month or whatever it may be because it's side income. Whereas if you're trading and that is your source of income, that's what you're putting bread on the table with, 3-4 months that you go by scratching, all of a sudden you're not making any money. You don't have another income to rely on. So when thinking of taking that step, it is very, very important to make sure that you're confident in your system, that you're making those returns consistently before doing so. And even when you do, that initial first few months is really difficult because your mindset changes. You could be on day 20 and be down on the month. You think, well, I can't have a down month, and then you start chasing. So it does affect the mindset. And I know a lot of people are taking up the challenge at the moment, the FTMOs and whatnot. And from what I've seen in my inbox, there's been a noticed effect with regards to the time pressure or the pressure because it is a different environment. So when we speak about treating trading like a business, there are various aspects that need to be taken into account. When we start trading, we generally have learned a few indicators, we've learned a few sort of systems or structures, and we don't realize that we don't have any risk management in place, we don't have any knowledge of what to really expect, and we actually end up gambling. And what I mean by that is we start to see patterns of the market start to move up and we start buying it and then we start selling it. And slowly we start to develop strategies and we improve and we improve and improve. But it's very important that trading shouldn't be fun. It shouldn't be getting your heart rate up. It should be methodical. It should be a process. It should be repeating that process time and time again. So the first important point of treating trade like a business is to make sure you're correctly capitalized. Probably the number one reason that people fail in trading is that they start off undercapitalized. So they put in say $1,000 or $5,000 and they expect to make $1 million in year 1, 2, 3, or 4, which is just not realistic. Okay, because I don't know why that is the perception of trading, that you can beat the markets, that you know where the market's going, and you can make these crazy returns. If you set up a business with $1,000 and at the end of the year you're at $1,500, you've made 50%. Any business that makes 50% in their first year is over the moon happy. Yet what happens is when we start with such a small amount, and there's nothing wrong, I'm not saying you can't start that amount, you can start with any amount, but then don't expect to double, triple, quadruple account because that's not the way it works. If you are starting with that amount, and say in year 1, you have a brilliant year, you double your account, you have $2,000. What essentially happens is you think, well, I'm brilliant, I'm a great trader, I know what I'm doing, but the amounts are too small, so you start risking bigger sums, or you start saying, yes, I know I've now got $2,000, but I'm going to treat my account as if it's $6,000, and then you actually take risks worth of that, which is significantly more than you should do. And even if it works, you then get to $12,000, $20,000. But the fact is you keep taking those risks, it's going to catch up to you and you are going to end up blowing your account. So it is imperative that when you decide to start trading, whether it's, I won't say seriously or not seriously, but when you're taking it seriously, that you are capitalized correctly. Because if you're not, you are going to come unstuck, or you need to lower your expectations. So if you're starting with those sort of sums, then you've got to actually acknowledge what's a good year, what your goals are. If you start setting unrealistic goals and you're undercapitalized, you are going to come unstuck because your risk management is going to go out the window. That's without a doubt. There are also going to be trades that you can't take if you are doing it properly because you don't have the capital to take those trades on. So you've got to trade with money you can afford to lose, and you've got to make sure that you have the right amount. Because if you don't, it is going to affect your trading. Without a doubt, it is going to affect your trading. So that is just very, very important. Then you need to find a system that works for you. Okay, this is your edge in the market. Now, a system can be anything. It can be, my structure that I teach. It could be as simple as I'm going to follow Greg's trades, or I'm going to trade only 1-2 setups, or I'm going to trade wave 4. Whatever it may be, you've got to come up with that system that you're confident in, that system that works, that's worked for you, it's proved to work for you, and that you can replicate it in all conditions in the market, but more so, you can scale it to trade with any size. So that's where the structure comes in. Like the approach that I teach, it's very structured. It doesn't matter what size. You can have a $5,000 account, or you can have a $1, $2, $3, $4, $10 million account. It makes zero difference because everything is set in a certain structure and it's scalable to absolutely any size, which is very important. You've also got to allow the system to work. And I'm happy to say I've seen a lot less of it recently, but a lot what I had seen sort of 3-4 months ago, perhaps it's because the markets have been quiet and the room's generally been a bit quiet the last month or so. But when we were quite busy and we were seeing lots of trades and I was putting trades out daily, I was seeing stop loss put in the incorrect place. So if you're going to use a system and you're going to use a structure which says, I'm trading 1-2s, I know this is valid for as long as we're above the 2, but you put your stop loss in the wrong place, you're not allowing your system to work. And that goes for anything, whether you're using clouds, whether it's any wave, whether it's price analysis, order flow, whatever it is, you've got to have your stops in the right place. You've got to have your sizing correct. You've got to have faith in your system, but you've got to allow the system to work. Over managing, watching a trade, go, oh, I'm not sure, that might be 3, that might be 5, and stop playing around with it when the market's done nothing to invalidate your theory or taking profits too early is not allowing your system to work. So you've got to come up with that system. It needs to be that structured system. Again, it doesn't matter what it is. There are many ways to skin a cat. I actually want to go back to something that somebody told me yesterday, where there was a mention of that he's using Ikemoto Cloud with Elliott Wave because it's helping him sort of giving him more information. And I had another member ask me, well, why do I just do my Elliott Wave? Why don't I incorporate some other stuff with it? And my answer was very simple. I don't need to. My system works. I'm making money. I don't need to change. Is my system bulletproof? No. There is no holy grail. There is no system in the world that is going to work every single time. By incorporating other stuff, and again, for those that don't know, I'm well adversed in multiple forms of technical analysis. I've studied for many years multiple. I can go through the list. And my choice is the system that I use because it works the best for me. That doesn't mean I can't apply anything else, but the reason I don't is, yes, in certain instances it will give me more information, but in other instances it's going to confuse and cause a contradiction to what I'm trying to do. So the benefit kind of is equal to the downside or the too much information syndrome that it gives you that actually causes that confusion or makes you doubt yourself or doubt certain trades because you're getting conflicting information. So that is why I don't really, of course I use basic technical analysis and I do apply that to the markets as well, but I have a system, it works for me. I'm not interested in trying to incorporate other stuff into it because why change something that's working? I know this works. I proved it over many, many years. I don't need to look for that, and that's something you must all take into account as well. You'll have a system and it'll be working, but then somebody will throw some shiny indicator or some this, and you'll look at it and you'll start confusing it, and you don't need it. Again, The idea is not for me to be the best trader in the world, to be able to call every market to the penny all the time, because I don't need that. The reason I trade is to make money. I'm not competing against some guy in America to say who's a better trader, him or me. That's irrelevant to me. My point is to make money. Your job as a trader is to make money. So it doesn't matter. You're not going to find a system, and I can tell you that from someone who studied it, not all of them, but a big majority, a large chunk of them, that's going to be the holy grail. That go, right, this is it, this is going to work. Every system has advantages, every system has some disadvantages. It doesn't matter which system you use, as long as you have an edge within the system and that you can apply it correctly time and time again. So I think it's very, very important to acknowledge that you're not going to find some shiny indicator that's going to make you the money and you're going to beat the market time and time and time again. You're going to find a system. It's going to be good. It's going to miss something. It's going to have pros. It's going to have cons. But if there's an edge in there, that is what you need to do, and you need to replicate it time and time again. And that's where you're going to make your money in the markets. The next thing is to be prepared when you enter the market. Okay? A lot of people are not prepared. They come to the market, put some money in, start throwing some stuff around, and start learning on the job by blowing accounts, and they slowly learn and learn and learn. So what I mean by being prepared, so now you're treating it like a business. You're taking your trading seriously. You've practiced on a small account or a demo. I say use a small account, even if it's the smallest account in the world. I know it doesn't apply to a lot of you because you've all been trading a while, but generally, I don't like a demo because you don't treat it seriously. And I know people say, yes, but I'm going to, and I do. You don't. You put a position on, even if you're watching it, you go to the pub, have a few drinks, you come back, you see, oh, I'm up a big chunk, you take your profits, or, oh, it's so far offside, it doesn't matter. 20 days later, you sell it because the positions come around. It's not realistic trading conditions, and I don't care who you are, it's very, very difficult to treat a demo and to replicate it. And it's something I actually implemented very, very early on. When I was trading, I was training graduates, trading fixed income futures. And when they came through the program before I took over, they used to trade on the demo accounts. And instead, when I took over, the first thing I did was allow them to trade one lot sizes on my account, just because they could get that real feel. And you could see immediately the difference between what was in place and how people started out to how the people came through when the real money was on. Because when it was demo, they walk around, they don't really care, they mess around. As soon as it's real money, doesn't matter the size, glued to the screen, what about this, what about that, thinking, analyzing, trying. So very important is to start on a small account as opposed to a demo, in my opinion. Also being prepared means you spend a lot of time on psychology of trading, you spend time on working on your system, you're confident, you're ready, everything you have in place. You're prepared, you know what to expect. You know you're going to have down periods, you know you're going to have great runs, you know you need to stay neutral. You basically are prepared to enter the market to trade. Very important. You don't want to learn the nasty surprises or the certain things along the way. So that's very important. What else? Create rules. You need rules. And most importantly, you need to stick to them. Okay? What are rules? X amount you can lose per day. Percentage risk you'll take per trade, the maximum you'll take per trade. Okay, you should never allow a trade to define your week, your month, your year. It should never ever happen. The most I will ever risk on any trade is 2%. That means I can wake up and we've had a corona drop and I'll lose 2% plus the slippage from my broker. But I'll not lose more than 2% on any trade. And the reason for that is very simple. I know I have an edge. I know I can beat the market. I do beat the market over time. What I don't know is when I'm in a given trade, if that one is going to work out or not. So if I risk 50% on a trade, 30% on a trade, I could damage my account. But if I'm risking 2% per trade, I know my edge over time will allow me to make money. Even if I go on a bad run and I lose 5 trades in a row, the most I can lose is 10% of my account. I mean, often I don't trade 2%, I often trade 1%, but even if I go 5 big swing trades and I've lost 10%, my account's still intact. But I know over time I will make money if I keep applying what I'm doing, even if I'm going through a bad run. So it's very important to have those rules. You need to have rules such as what's the max amount you can lose per day. So I separate my scalping from my swing trading, and that's from a percentage per day and it's a percentage per trade. Other rules, you could be very strict. You could be, I'm only trading 1-2 setups. That means you do not trade fourth waves into fifth waves, or you do not trade C waves. Okay, you create these rules, and you create these rules what works for you. It's important as a trader not to be someone else. So someone might say to you, you should always trade only 2 markets, or you should always only trade during the morning time. It's an absolute nonsense. You need to, it's like anything. It's like a sportsman. You're a cricket player and you have your technique that's natural to you. Coaches will work around what comes natural to you. They're not going to go and say bat right-handed if you're left-handed. Okay? Trading's hard enough. The psychology of trading is hard enough. You need to formulate within, I mean, obviously certain things you have to be applied, certain rules, but when it comes to formulating, you need to do what suits your personality. Okay, so like the 1-2 setups. For me, I'm better off buying at the 2. Some people prefer buying the 1-2, the 2 after the 1-2, 1-2 because they got more confirmation, but they're buying higher. Other people might be breakout traders, and they might prefer to buy it once we get through the 0.764 after we have the 1-2, 1-2 in place. There's no right or wrong. I'll never say to you, this is where you should buy. This is what you should do. I will always say these are the points where one enters a trade. You need to take that and be, well, what suits me best? What is my style? Because if you're not a breakout trader and you're forcing yourself to buy that breakout, you're not going to perform. You're going to mess up the trade. You're not going to trade it properly because it's not your personality. Your personality is to buy support. Or if you are a breakout trader and you start buying support, then it's not in your style either. So you're going to not be comfortable doing it. So it's very important to be yourself. You have all the information, you have where you can buy, where you can't sell, where the rules, what you can risk. That you need to formulate to suit yourself. Don't try and do something that's unnatural to you because you will immediately, human nature will repel it. You're not going to continue doing something and then it's not going to work on a trade or two and you go, see, I knew it didn't work because it's not you. So you need to be yourself within reason. That's just very, very important to not be somebody else. Okay? You need to manage risk. The most important thing, if I had to say one line about trading, is that capital preservation is key. You have to be able to preserve your capital because once you run out of capital, it's game over. So that comes into the risk, it comes into the rules that you set, but it also means that, let's say the markets are moving really quickly, it's Corona's hit again and markets are moving and you're in a trade, it's moving, you're unsure. It's okay to say this is too volatile, this is too dangerous. I don't know what's happening. Markets are just flying everywhere. I'm not going to trade this. It's too risky for me to trade this because my number one is to preserve capital. So if you're not sure what's going on or you don't have an edge, there's no point gambling or trading for the sake of it. Just take a step back and wait until you have your edge again. Always think with, how can I preserve my capital? When I enter a trade, the first thing I do is I look at my risk. Okay, I don't look at how much I can make. So I look at the gold trade. My stop needs to go 1660 or whatever, or 664 I think it was. I work out. That's $50 away from where I bought it. So I've bought X amount of size. I want to risk 1% on this tranche. What is my stop? And a good way around that mentally is when you place a trade, is consider that money gone. So whether the trade, if it hits your stop, is going to cost you, I don't know, let's say $5,000, that is money that I've accepted I have lost. Okay? It doesn't mean that you have lost it, but in your head, that's money you're prepared to lose, you've accepted it, it's gone out. If it hits a winner, great. If I scratch it, great. But I'm not thinking when gold starts to get towards 1680, oh my God, I'm going to lose this amount of money, this is crazy. What's happened? Or why is this trade not worked out? Because in my head, I've mentally accepted that this trade's going to hit my stop. So I've treated that money as gone. Okay, and that way you don't panic, you don't freak out because you expect it, but more so, you've planned for it. You've worked out the percentage that you're prepared to lose. The market hits your stop. So what? You're not going to get every trade right. You are going to get stop outs. Taking losses in trading is totally part of the game. Okay? There's some good traders who I know who strike about 45, 48%, and they make serious money. Okay, I strike at a higher rate than that, but it doesn't matter. It shows you that even if you're striking at those rates, if your system's correct and your ratios are right, you can still make money. You don't even need to be better than 50%. Okay, that is important to know. People think that, oh my gosh, you're a trader. You must be able to call the market right all the time. People assume traders are right 90% of the time, and that's what makes them money. Where in reality, a good trader is a good money manager. So you just need to be able to manage your money, manage your setups, and that is what will make you money in the long run. You're not going to go through a period where you're going to call the market 20 out of 20, 50 out of 50, 100 out of 100 times, because you don't need to. But it's important that when you do take losses, that you accept it and you don't do anything crazy. But it's also important that your losses are small. So there should be 4 types of trades that you take, or 4 results for your trade. There should be big wins, small wins, scratches, and small losses. You've got to eradicate the big loss from your vocabulary. And this is what happens with a lot of newer traders. They sort of get to the point where they finally click, they get to the point where they're right. They can actually beat the market. They know what they're doing, their setups work, but they don't have their risk management right. So they spend the first 15 days of the, say, 20-day working month making money, like slowly grind the account up, and then in one day, they have to take one big loss, and that wipes out their whole month's profits, and then totally lose their head or totally can't believe how they've worked so hard to end the month flat. Or even worse, one big trade turns a month into a loss and wipes them out. So long as you can take care of those big losses, the rest will take care of themselves. If you can make sure that the losses you take are small losses, even if it's more frequent. But what happens is, we're in a position, we know it's invalidated, we know it's not working, you can see it clearly, but you think, well, what if the market still goes higher? And then, guess what, the market goes, hits your stop, and you think, well, I could have easily cut that earlier, why didn't I? Because you were worried about what if the market pushed on higher and the trade worked out, even though you knew it was a failed 3-wave move, and the likelihood was now that the setup was going to break down. But you couldn't get yourself to actually go and take the loss. So that's quite common. Okay, it shouldn't be a problem because you've still got your stop in the right place and you just take that loss. But if you know a market's going to hit your stop 5 times in a month and you could sell that at break even or for a slight loss, that's 5 less losses you've got to take in a month. Okay, and it's important. What are the characteristics of the best traders in the world? They all can cut their losses without without a shadow of a blinking, without even any hesitation. It's not working, get me out. Do you think they care if the market goes higher afterwards? No, because at that time you made the right decision. And that's important. You don't need to watch the market once you're out the market, glued to it and go, I shouldn't have sold, why did I sell? Or the market's going higher, I've made 5% of the trade, but the market's going higher, why did I sell here? Take your profits, move on to the next trade. Only worry what's important, and what's important is your account. It does not matter. When you sold for a reason. Who cares if the market goes up higher? And you'll find that the market probably balances out. Half the time it goes up higher to sell, half the time you sell at the right place and it goes down lower. And that's why a lot of members have asked me, well, what if wave 3 extends? In other words, what if I've bought the 2 and I've sold at the 1.618 and it goes to the 3 extension? Well, my answer is simple. I've made a good chunk of money. Do I care that I've missed out on some part of the move? No. It's a successful trade. Move on to the next trade. I will never watch a market after I sell and think what ifs, because it's totally irrelevant. My sole goal is to make money. Do I care that I could have made a bit more? No, because if I had a crystal ball, sure, I would have still at the exact top. But it's not possible. And one does not need to buy the bottom and sell the top to make money. It's the meat of the move that makes us our money. So again, if you've got those 1-2 setups, you're selling at the 1.618 or the 1.236 or the 2 extension, it doesn't matter if we get extensions. You've bought, it's hit your levels, next trade. Keep repeating that, move on to the next, keep ticking the account over, and you don't need to worry about what happens afterwards. And it's very important, because I know a lot of people get down and it actually causes their psyche to change and to start doing silly things, because they start saying, well, if I didn't sell here and I sold a day later, I would now have all this extra money, and then you feel like you should have that money and you start pressing extra buttons, or you take a little bit bigger size, you say, okay, just this time I'm going to trade a little bit bigger. And I'm sure some of the stuff I'm saying is resonating with you. And then you do that and it ends up being a loss. And you think, well, how am I down or how am I flat after having such a great trade? Because you've just done one thing silly, which was triggered by the fact that you never sold at the high point. So it's very, very important not to get too absorbed with that, and just remember, once you're out of capital, it's game over. So the first thought in your mind should always be capital preservation. It's the most important thing I could say in this video today, is to make sure that your capital is preserved. The next thing is to put in the hard work, like you would do if it was your business. Okay? If you were running a business and it wasn't doing so well, you would spend time reviewing, you'd spend time working on it, you'd try to find ways that you can make yourself better, that you can make the business work. But often with traders, you tend to cut corners. You think, well, okay, it's not working, I'm going to go see, and then just copy Greg's trades, or I'm going to go see what this guy's doing on Twitter, or I'm going to, you don't take a step back and go, right, it hasn't worked for me, what's gone wrong? And you spend the week going through what happened. When you get onto journalizing trades and performances afterwards, you've got to spend time working, finding ways that you can improve. So it's very important to put the hard work in. I still, every morning, I wake up, I say hello to you guys, and I spend an hour, maybe 45 minutes, up to an hour max, scanning my chart. What happened overnight? See if I need to do any change. I do that for all my major charts I look at. And that's something I do every single morning. Half the time I don't need to do that because the markets haven't moved on the biggest gap, but I need to make sure that I'm prepared. By the time I've done the morning updates, I'm already know what my plan is for the day. I know what markets I'm looking at. I know where I'm looking for the markets to come. I know every market, what I'm looking to achieve on the day by 9 o'clock in the morning. Well, normally by 7 o'clock in the morning, but there is no set time. Before I place a trade, I've done my work, I'm ready to start my day. If you just roll up, turn on your computer, go, right, oh, gold, 17.55, good price, buy. You're not going to make money. You're not prepared. You've just seen something, you've seen the market at a certain point, you think, okay, it's within the zone, let's just buy. You need to spend time before putting in the hard yards. Make sure that you are prepared. Before you start your day, you are prepared. It's the same thing. You wouldn't go into a business meeting and you wouldn't go buy another business if you hadn't done work on the other company. So why would you come into the market and just buy something as you've opened your eyes and still pouring your coffee in the morning? It shouldn't be like that. You should always make sure that you've done the work before. So there's no excuse not to put in the hard work. And that brings me to journalizing performance. Okay, very, very key component is to journalize performance, review your trades, and I say do it weekly. Some people say daily. I think daily becomes too much, and I don't think it's that as useful. I think it's important to do it weekly, and I also think it's important to not only do your losses, to do your winning trades as well. And the reason I say this is, when you do this review, you'll find out that some of your winning trades were actually bad trades. And some of your losses were fine trades, it's just the setup didn't work out, which is totally fine. If you're trading legitimate 1-2 setups and it breaks support, so be it. Again, it's not going to work every time, but it will work significantly more than 50% of the time and will offer you great risk reward. And if you can get in the habit of saying, I've traded these setups, I've traded perfectly, and I've lost money, then that's it. You've had a bad week. The markets and broken your setups. That's totally fine. It happens. But if you start reviewing your trades and you can see what you've been doing wrong, or you can see, okay, I'm trading too many corrective patterns. I'm trading fourth into fifth waves. That hasn't worked for me. But if I look at the 10 trades I took, the 3 that I got right were the 1-2 setups, and they were on this time frame, and they were on this product. So you start to develop more and more information. Okay, it's the same thing. When you run a company, how many reviews do you have? Staff reviews, product reviews. Okay, it's constant. It's the same thing. What you're doing by journalizing your performance and reviewing it is you're constantly improving yourself. You're constantly looking at what you did well, what you did right. But at the same time, you can't skim over the winning trade. If you've hit a good trade or winning trade, but it wasn't a 1-2 setup, or it was a wrong structure, it's actually not a good trade. And that's what's important to acknowledge. Just because it's a winner doesn't mean it's a good trade. You can get lucky in markets, for sure. You can trade something which is a poor trade, your risk management your stop was in the wrong place, but the trade worked out. That doesn't mean it's a good trade. So it's very important, and I must say it does help you improve massively, because you can see, or you're counting what's working, what's not working, what products work best for me, am I trading too much corrective patterns, and you start to build a picture, and that actually helps with the confidence. The last point I want to mention, and this is also very important, is to acknowledge that markets are dynamic. Okay, you have to keep adapting to markets. They're forever changing. What worked last year might not work this year, and this is why one can never become complacent. Okay, you can never become complacent in the market, because the market will humble you. And that's why I say it doesn't matter how well you're doing, don't change what you're doing, keep doing what you're doing. If you're on a bad run, don't get down. You've got to also adapt. So, like I said, the textbooks that you've all read say wave 4 retrace 0.382. Well, in today's markets, they tend to be a bit deeper, up to 0.5, and that's why I've acknowledged that. This year, specifically, a lot of the markets I follow have been retracing to the 0.764 more frequently than most, on where historically the wave 2 should have 0.5, 0.618. That's been to the 0.618, 0.764. So I know I've been buying a little bit later. I hardly buy wave 2 to the 0.5 anymore. But that might change next year, and I'll go back to that. So I'm constantly looking to improve what I'm doing, or I can see what I'm trading, where the markets are, and I'm going to keep adapting. We've also seen a lot more in the last 3 months, a lot more diagonals than normal. I mean, diagonals are actually not that common. But with this chop that we've seen in the last sort of few months, we're seeing more and more and more diagonals, and I acknowledge that. So just these small things that you pick up, and things do change. And finally, on this topic, I want to add was something that I think you should avoid. It's probably a little bit controversial. It's probably not what most people will tell you. But creating certain goals, I think, is something that you need to be careful with. Okay, you should always have a goal. 5 years' time, I want to do this. 10 years' time, I want to do this. But what people do is they create weekly goals, monthly goals. So you say to yourself, I need to make 5% this week. What actually happens? You're on day 3 of the week, you level on the week, you're searching around crazy, looking for trades, forcing trades so that you can make your 5% on the week. What are you actually doing? You're not even trading the market. You're not even trading the system anymore. You're trading the money in your account, because you feel the need to make this 5%. And it's a total way to blow up accounts, total way to lose focus. I much prefer to be, these are my system, this is the setups I'm trading, I have faith in my setup that if I keep doing the right thing, following my rules, following my system, I will make money in the long run, and you let the rest take care of itself. The only thing you can control is your entries, picking the right setups, putting your stops in the right place, sizing correctly, managing your risk correctly. The rest will take care of itself. So I say avoid short-term goals, I suppose is a better way of putting it, because it puts you under pressure, unnecessary pressure, but more so, it stops you trading the way you should be trading, which is the methodical approach through the system. When you start saying, I need to make 10% every month, that'll make 120% per year, that'll be a great year. Oh my gosh, 3 months in, I'm only up 5%. And I'm 25% behind the curve. I need to make 10% the next month. How do I have a 35% month? Guess what? Sizes start increasing. You stay up at 2 o'clock in the morning looking for trades. Okay, you totally, and then you make $1,000 on a trade. You go, right, I need 34 more. And you make 10,000, right, I need 24 more. Your whole mindset is to trade to make that money, and you're forcing yourself to make that amount of money. And guess what? It does not work. So I say avoid those goals, but obviously you should have goals in the sense that, let's say you're trading a $10,000 account, you might say, right, in 5 years' time, I want to make this a $100 account, or whatever it may be. I mean, I don't want to use random figures. But the beauty of trading is the fact that your profits compound, and that's where you become successful in trading, not hitting one-hit wonders. Okay? Every year you make profit, your account increases. You then can increase your risk because you've got a big account size. And so the next year, that money gets compounded as your size increases. That's how your account grows and grows and grows over time. What doesn't happen is you start with $1,000 and then you expect to make $1 million, because that is just not going to happen unless you're dealing in the crypto alt world. That's crazy things have happened there. But in general, in markets, you can't expect things like that to happen. And I know we spoke about that in the beginning. So those are the key points when it comes to treating it like a business. Those are literally the important parts of what needs to follow. And it might be a cliche, but what is so true is if you can control your losses, you can control the risk, you can control the psychology side of it, the winners will take care of themselves. What we try and do is we try and control everything, okay? Once you place a trade, your stop's in the right place, your target level's on the right place, there's nothing you can do until the market does something that it shouldn't do. So it's very important to keep that in mind. There's only certain things that we can control, and if we do that correctly, it puts us in a position to make money in these markets. Any questions with that? That all makes sense?
Yeah, so good model.
Good.
Yep, very good.
Okay, so
Quick question, Greg.
Yeah.
About journaling. How to journal? Do you have some kind of Excel sheet or something to journal the trades and to determine which one? How to categorize and determine what was a good or a bad trade according to the setups we know to deal with?
So again, you missed this part.
I'm struggling with it.
No problem. So you missed this part at the beginning. It's very important.
Oh, sorry, okay.
No problem. It's very important to stick to your own personality and not force something that's not you. So you must decide on what's important. There's no set answer to that, because you're going to review something differently to the way I'm going to review something. So for me, for example, what might be important is, am I trading my right setups? Am I trading too many corrective setups? But for you, what might be important is my stop losses in the right place. So whatever you're struggling with, whatever you find that you want to journal, that you find important to your style, to your personality, is what you need to put in there. Because you're going to analyze it differently. Again, you're not analyzing it from was it a good trade, was it a bad trade? Say good trade, bad trade, good trade, bad trade. I did 5 good trades, I did 5 bad trades. You're reviewing it from a perspective of, I have risked too much this week. That's what's gone wrong. I've taken a big loss. Why have I taken that big loss? Okay, what's my problem? My problem is my stop loss is in the wrong place. Okay, every week, was it in the right place? Yes. Okay. Did I try to get too greedy? Is the market going in my direction, not hitting my prices that I have in mind? So you need to categorize that to suit yourself. There is no right or wrong answer on what you should be reviewing. You need to decide what you should be reviewing. But the point of the review is to pick up what you're doing wrong? What's affecting your result? Is it the size? Is it the stop loss placement? Is it the trading the wrong setups? Is it wave counting incorrectly? And as you go on, you're going to change what you're journalizing, right? Because you're going to focus more on different parts. So it's personal to what's affecting you. I mean, I'm happy to give you pointers and tips and the stuff that should be there, but at the end of the day, I'm not here to clone everybody to be me. I'm here to give you all that information, guide you in the right direction, and let you be you. Because if I decide to say you should all trade like me, it might not be your personality, and you're not going to get the same results as me, but you might be able to get the same results or better results than me if you trade with that information and customize it to yourself.
Okay, thank you, Greg.
No problem. Right, so let's deal with certain issues we're currently experiencing. I mean, one that I'd imagine or I'd assume that someone's feeling right now is the frustration in the market. Okay, not because we're doing badly, but because metals have been in this consolidation for an incredibly long period. S&P and the other indices are in this fourth wave move. It's been, for metals and indice traders the last month, it's been hard work. It hasn't been great setups. That's why I haven't been posting that many setups recently. Yes, we position ourselves on the swing side and whatnot, but that frustration, maybe some people are feeling it. I'd assume somebody's feeling it, and maybe that's getting you anxious, looking around to other markets, or, getting you feeling that you need to do something, perhaps when there isn't something to do. So that's something I'd expect with the markets, the way they have been recently. But is there anything you guys want to discuss? What has affected you, is affecting you? And let's try iron them out or sort of go through them. So feel free to shout if anybody has anything they want to add to that or any questions, and we'll try and delve into them.
Yeah, I don't want to make it all about me, but obviously having the target of a percentage to hit for the challenge is really messing with my head.
Yeah, so that's something we spoke about. That's exactly why I say, and it doesn't apply to you in this instance because you can't help it, it's very difficult to set weekly or monthly goals, right?
Insanely.
Right, so now we haven't had great market conditions the last few weeks, but now you have to make this money if you want to pass the challenge. So what do? You start looking for trades because you don't have another option. It's a very bad place to be as a trader, being forced to find trades for the sake of it. So, it's difficult because if you were trading a book, you can be patient. I mean, the amount of trades I've taken the last month is significantly less than my average that I'll take. And that's quite simply because the market hasn't given me reason to take trades. Hopefully these metals get going and I can be trading, I can be scalping scalping around my swing positions daily. So besides crypto, to be fair, crypto's been moving well. I've been trading a fair chunk there. It's probably why I've been spending a lot more time focusing on the crypto market, because it's been the one that's been moving while my major markets haven't been moving, or they're not in a position I want to buy. So I can't actually give you much help because you don't have an option. Because otherwise you fail if you don't do anything, you fail the challenge. If you overtrade and lose money, well, you fail the challenge anyway.
Yeah, it's a bit of a tricky situation.
So unfortunately, there's not much I can say because you're in a situation where you have that pressure and you can't help it. If you're trading your own account, my answer to you is be patient. You know that the setups are going to come, and when they do come, you maximize them.
Yeah, because I tried to go on kind of a damage control and just drop sizes and everything, but I found that actually, like you mentioned to me, made me too cautious.
Yeah, because now again, it's exactly what I spoke about right at the beginning, the difference between trading when you have a job and you have other income coming in, and trading as your sole source of income. So although it's not your sole source of income, it becomes like that because you have a challenge that you sort of have to trade because you have to pass it. And the additional pressures you're not used to. You're not used to sitting on a Thursday going, I need to make another 2% today to meet my target. What can I trade? Immediately your mindset's in the wrong place. So what happens is you have a month, say, and you need to make 10%, I think it is, 5% the second one, and you level, and you think, well, I can't afford to go down 1% because then I'm not going to reach my target. So the trade starts to go against you, you become nervous, you sell too early. Then you take a trade and the market quickly goes up in your favor, and you immediately take your profit to cancel out the trade that you lost because you've got to reach your 5% target. So you end up trading the money and not trading the setups. Okay, it's exactly what we spoke about at the beginning. That is what happens. When you have these targets, you totally forget what you're doing. You're not trading in a state where you're looking to beat the market. You've got your setup, you know where the market should go. You purely taking profits early to keep the account going forward. You're selling too early and you're just making a total mess out of it. I'm not saying you make a mess out of it, I mean the person in general makes a mess out of it. Very, very important not to do that. You've got to, what got you there in the first place? How did you pass the first challenge so easy and quickly? You were trading big setups, you didn't know much more, the setups were working, it was great. Now we've had harder market conditions, and if you go and you're journalizing and you're looking at the trades you're taking, and you could say, were you really trading it the exact same way? Were you holding to the way you were holding before? Or before the challenge, when you were trading your own account, you were trading smaller size, did you have those same emotions? No. Because you were doing the right thing. You were trading the setup for what you learned and what was working for you. As soon as the size went up, as soon as the pressure increased, things started to change. So that's where journalizing is very important. You've got to make sure that you are trading markets. So that's what I do as well. I have two accounts. One's my swing account. I don't look at my swing account every day, and only when I need to change something. I don't want to watch the money go up and down because that's going to make me make decisions. So I don't sit and look at my balance every day on my swing trades because I don't trade the balance. Okay, I don't care what I change on a daily basis. I'm trading the setups. I'm trading the market. If I sat there with the screen with my swing trades open all day and go, oh, that's a lot of money turning up and down every day, I would probably think differently and I'll probably overmanage it and I'll make mistakes. But I know if I don't need to watch it, all I need to do is when I need to do something, I can see the market, I've got my charts, and I can say, okay, it's not working, all right, I'm going to take something off here, I can go and change it, and I do it, put my orders or my managing, and I switch it back off again. Okay, scalping's different. I have that open all the time. But it's just important, little things like that. When you're watching the money tick in front of you, you start trading the money. I've put steps in place to stop me trading the money, to trade my setups, because I trust my work and I trust my setups. The money takes care of itself. So that's the important part, is just to find these things that might be affecting you and put things in place to try and improve it. All good?
Yeah, that's clear. Thanks.
Sure. Anyone else?
Yeah, no, I think that's spot on. Is that I also have a look at my account balance, and you see the money goes up and down. So I'm definitely influenced by that, and not trading the market, trading your balance. It's a good point.
Very common.
Yeah.
Because at the end of the day, as a trader, you almost become numb to money. And what I mean by that is money in trading, I don't see as money in real life. Okay? It's all a bunch of numbers to me. Because if I was watching it and go, oh, that's a lot of money. I could buy a car with that. Or, oh, that's a lot of money. Your mind is totally influenced by those figures as it goes up and down per day. But I know if I get my setups right, those numbers will keep increasing. And then when I sit back, when I'm finished or I want to break, whatever, then those numbers get converted into money and it becomes money again. So it's important. Treat them like Smarties. It's not money. It's money in your account. It's money you've accepted you can afford to lose. And your job is to make those numbers grow. But as soon as you start looking at it like money, again, it is going to influence you. And that's why I don't look at my swing account, because it will, for someone like myself who's traded for many years, it will still influence me for sure if I watch it tick every day.
Yeah.
Okay. So yeah, that's definitely a human psychology issue that affects everybody. And that's why we can put steps in place to prevent it. And the truth of it is, how often do you need to look at your swing account? I know where I bought my gold. I know where I bought my silver. Doesn't matter right now if it's up 10,000 or if it's up 40,000. No, it makes zero difference. Because I'm not selling it now. My idea is to sell it at my prices that I want to sell it. So that's the most important part. I don't need to watch the money. I know when I need to do something, and then I'll adjust it. Anyone else? Any questions? Floor's open.
I got a question, Greg.
Yeah.
Hello?
Yeah, fire away.
Okay, the last sort of problem I got, which happens to me a lot, I'll make a plan, and it happened in gold last Friday. It shot up. That was my plan. And I watched, I argue with the market, so to speak. The market went down. I said, oh, it's going to come back up. It's going to come back up. And I watched it go all the way to the bottom again.
Okay.
I didn't lose on the trade, but I saw the top and I believed that it was going to carry on so much. I didn't get out of the trade. Is there anything you can do to sort of get around that?
Yes, definitely. So when you took that trade, what was your plan for the trade? Was it a swing trade or was it a scalp trade?
It was to get out on that day with, I wasn't going to keep it more than Friday.
Okay. So what do we know? We know that we're looking for a breakout, and for it to be confirmed a breakout, we need to see a 5-wave move. So once it topped out and started dropping, we knew it was only 3 waves. You could have firmed the length of the wave 3 and drawn your support box for wave 4 between the 0.382 and the 0.5. And as soon as the market broke the 0.5, you knew you don't have an impulse, and you could have moved your stop to there and at least locked in some profit. Okay?
Yeah, I think what it is, you always get little retraces, on those big moves anyway, on other pairs. It was one big retrace, basically.
Yes, but it broke support. Once support broke, if you were scalping, you would have taken your profits. So yes, I agree. It would be very difficult to get out at the highs because it looked like it was a breakout. Again, I was asleep.
That's right.
I didn't trade it live. So I wouldn't have expected this example. It's not realistic to think you could have sold the top. But you would be managing it. You would have drawn your fibs. You would have known your support for where the market needs to hold on any retrace. And as soon as it broke that level, you could have feasibly locked in $10, $12 on gold and silver, probably 30, 40 cents comfortably. Okay, if you swing trade, It wouldn't make a difference because you'll still be holding your positions like we are now. But if you were scalping that, if I was awake and I was scalping that, again, this comes to the preparation I spoke about. I would have been managing my trade. I would have been seeing where the market breaks, where it would affect me. Now, if we held 4th wave support and got a wave 5, I would then move that box and I'll start drawing where the retrace box should go. So I'm constantly watching my trades in the sense of what needs to hold to make sure it works. And as soon as something breaks, I don't hesitate. That's it. Can I form a diagonal and go higher? Yes. Can do it without me. I'm taking my profits. Good night. Next trade. I'm not worried if the market did that. So if you were managing it correctly, you would have sold the break of the 50% of the wave 3.
Right. Okay.
Anyone else? Open floor. What's bothering you? There must be something. Anybody been frustrated by the recent action, causing you to force other trades in other markets? Am I the only one that gets frustrated by what we've seen in metals and indices recently?
No, Greg. Of course, we're all frustrated to a certain extent, but all good. Just following the plan. Yeah,
but that's exactly it. And the important thing is, has anybody who took gold and silver as a swing trade sold their positions, or is everyone still holding it?
Still holding.
Still holding.
Okay, so that's positive. That shows you throughout this frustration you haven't done anything silly because nothing's invalidated from our setup. So that's a very good step. If people who were holding for swings have sold it because they thought, okay, micro can still go a bit lower, that would be what this market's doing, right? The idea of this is to force as many people out the market as possible, people to give up, like we saw that person post the grave of the metals, and then the market shoots up without them, and then everybody chases it, and that causes the third wave higher. Everybody thinks they don't want to miss the boat, and they've sold their position. So that's a positive, that you've kept to your guns, you've kept to your principles, because there's been zero reason to sell your metals position because nothing's changed. It just hasn't moved, which is frustrating, but it hasn't broken any setups. If it starts to break support, then it starts to break support. Then you need to take action. But nothing is broken right now. I still sit with the same positions I've had for a week, well, longer than that, but I haven't touched it since I added a week or so ago from the original ones, but I haven't done anything since, and I'm not going to do anything unless the market tells me to do something. So hopefully this frustration ends. I'm seeing signs we could break out today, but there've been so many fake outs that I don't want to preempt it, but I wouldn't be surprised to see it finally get going today. But let's see. I've said this before, and it keeps coming back in. But yeah, we'll see what we get.
It just feels like we've been in a prolonged frustration and fourth wave since last year.
Literally August last year, you were around, Jeff. I literally, as soon as we topped out, I mapped out, we're going into fourth wave. We called the top absolutely perfectly. But never in my wildest dreams I expect us over a year later to still be in this fourth wave. It's just, and that's why I'm saying we are so long in the tooth for this correction that if metals do start to take off, they usually, when they rally out of these consolidation periods, they're electric. When you've consolidated a base for over a year, the pent-up demand, the pent-up energy in this market is crazy. So if we do start to break higher, it could be a fun ride, and it could be one of those where you're just sitting with your stops in profit and you're just not touching anything, okay? There's a time, at one point, which I'll actually end on, there's a time to manage your trades, there's a time to be overactive, and there's a time for the lazy river trading, which is the best kind of trading. You're in a third wave, you don't have to do anything. You just have your stop in the right place and you let the market play out. It is the greatest feeling, especially with metals, when you've caught the third wave and you're just sitting back and you're watching it go. When you're in fourth waves or when you're in wave ones, you perhaps manage a bit more. But when you're in a wave three, especially with metals, you literally do not touch your core. You guess your scalp, you trade around it, whatever you want to do, you manage it, but your core position is just stays. Sometimes less is more, and when you're in a third wave for metals, less is certainly more. But hopefully we'll get to experience that in the next few months. But we'll see. Again, you all know my views on gold, silver. I've bet them time and time again. The one part that does not concern me, but does come into my thinking, is that they do tend to really wipe everybody out before they run for real. Like we saw with Corona when silver dropped to $11 and then broke higher. Those wave twos on the charts are a possibility. And all I can say is if they do play out, again, not my expectation, it's not a time to panic, it's a time to get aggressive. Because if we do drop immediately in the wave twos now, then my targets for this leg higher increase from 2,000, 2.5, sorry. If it's a B wave, 19,000, 2,000. If it's a wave 5, 2,500. They will increase to 4, 5, 6,000 for gold, and they'll increase to 75, even up to $100 for silver if we get a wave 2 now. Whereas I'm only expecting $30 to $35 or so on this move before we get a pullback, and then the real move. So if we do get a washout in metals, then it's actually a gift in the long picture, in the bigger picture, and will save us a lot of time. But it is important just to keep all options on the table. Anything can happen. It is a market. We trade the probabilities, and right now we're looking for that breakout towards $30, $35. Right, on that note, I'm going to wrap it up. I hope that was informative. I hope you enjoyed that, and I'll see you guys back in the room.
Thanks, Zach. Great
Pleasure. Cheers, guys.
Thanks, Greg. Cheers.